Okay,
right.
let's push ahead now to the discussion. Just before going into that, let me just say to all of those still listening in, you can ask questions. In order to ask questions, you can send them in the little the panel, which is shaded in red on your screen there. Those questions will come to me, and at the end of the discussion, I will then ask a couple of those questions on your behalf. With that, I'd like to pass over to my colleague, Matt McCleery, President of Marine Money International, to moderate the session. Matt, please.
Great. Thank you, Kevin, and welcome everyone. It's a pleasure to have the opportunity to moderate this final panel of the day. And you know, the webinars certainly don't replace getting together, but I think they've been so important in helping us as a industry kind of stay together and stay connected. And so I appreciate everyone's involvement of what we're doing. It's really a pleasure to moderate this final panel. We have just a tremendous group. I actually put together some questions and I sent them to the guys, and Andy said, oh, they're great, but it's going to take us 3 days to get through them. So I think we'll just get right into it here. I don't think any of these guys really need much of an introduction, but I will just kind of quickly do one. Peder is the CFO of Golden Ocean, which is the John Frederickson sponsored public dry bulk company. Peder, how many ships are you guys looking after?
We own just close to 70, and then we have leased ships that brings it up to around 77, and then we also manage commercially ships from our sponsors' main or private fleet. So we operate around 100 ships.
100 ships. Okay, great. And John Michael Radziwill,
yes.
JM, you have a private owning company, Goodbulk, which I believe is a family business, right?
It's actually more of a public business on the NOTC.
Okay, the NOTC. And also CTM is a pool. And how many ships are you worrying about at night?
So between our Supermax and our joint venture with Capesize Chartering, not double counting any ships, we're looking at 220 ships every day in the spot market, and then kind of another 30 fully around the period market.
Okay.
Some of them belong to the other panelists, by the way.
Right. Okay. All right. That's a synergy. And Andy Dacy, of course, from JP Morgan, known to many of you. Don't be fooled by the logo on Andy's business card. He is not a capital provider. In this sense, he is truly a ship owner, and I've learned that over the years by proposing a lot of financing transactions. And Andy always says the same thing, which is, "I love you, Matt, but I don't provide capital. I'm a ship owner." So we have 3 owners, very different profiles. We have a sort of quasi-public, private one. We have a financial owner, and then we have a fully public company with one of the largest market caps. So a great mix of perspectives. I'm super interested, you guys, to hear your kind of views on a number of topics, and I think we're going to cover a few different areas in the time we have allotted. I want to start with kind of global macro, and what I mean by that is, you know, we're living like in an extraordinary time if you look at monetary and fiscal conditions. We have a global synchronized stimulus underway. There's been about 20 trillion of money supply created. Most financial assets are at all-time highs. We have bonds and other interest rates at or below zero, and well below zero if adjusted for inflation. So my first question is, in light of all that, in light of the new U.S. administration, Peder, when you look out at 2021, how do you think this environment's going to affect your business, and what are you kind of planning for at Golden Ocean?
I think that you know, it looks very promising, coming from a sort of scenario where you really didn't know where the world would move. You know, the markets have recovered much quicker than we anticipated and feared, and we see now in Q1. I mean, we have the best dry bulk market that we had for a number of years, and this is driven by strong demand rebound for one, and then obviously we have also a lot of congestion in the Asian markets, which ties up a lot of ships. Not only driven by ice and weather, but also by the Australian situation, where there's a lot of Cape-size ships, being tied up. And I have to say, in a little longer perspective, you have, as you say, the stimulus package coming in from China, which is going to massively support demand, throughout this year and after that as well. And then that situation combined with a very, very promising supply side, where we have the lowest order book we've seen in a number of years. We have, emissions caps and so on that's going to move forward in the next few years, which is going to make older ships very, very little attractive to charter in, and you will see this being passed through the whole value chain. So I have to say, it does look very, very promising in the next 2 years.
That's great. JM, I see you nodding and smiling, so I'm thinking you agree with that?
I agree with that. I think let's start here. A buying heuristic for a shipping sector is when the order book is below 8%. Dry bulk's probably below 7% right now, and it's the lowest order book we've seen basically since the turn of the century. Well, since the turn of the century. So that's a huge thing, and our markets usually react very well to low supply. And then on the demand side, you've got global infrastructure initiatives, which is driving a lot of hard commodity seaborne trade. And then below it, you have a lot of countries securing food sources, which is, again, making for a very robust agricultural trade. So from the handy sizes up to the ore carriers, it looks fairly good. We've also had, and Peder mentioned it, we've had some added benefits. You've had some congestion. Also, you remember we have the Australia-China spat has displaced the seaborne coal trade. So you have a little bit more ton miles. And on top of that, you've had a big cold spell, especially in China. So that's also driven a lot of seaborne coal demand, which has soaked up a lot of ships. Maybe that ends, but the other two are staying. The other two demand drivers are staying there. So yeah, I mean, we're very positive going into N22 really. So yeah.
I mean, do you guys think that we could potentially see a situation like we saw in the container ship market earlier this year, where the underbuilt or call it relatively small fleet, hit with a kind of pent-up demand shock, and then basically available tonnage went to zero and rates went straight up? I mean, could that happen in dry bulk?
Well, let's start here. I hope it does. The container market's had its best run since 2008, and in 2007, 2008, dry bulk ships, or at least Cape sizes, on average, were about $100,000 a day. So I'm not sure if you get back to those levels. Never say never, but remember, you had a real coiled spring in containers of demand. And I think the infrastructural demand I talked about will be a little bit slower. And when I say coiled spring in containers, it seems as though because there's not a lot of services around, hotels, vacations, whatever, a lot of people have been buying goods, and those goods have gone on container ships. So for me, that's what does the demand. Will it be as good as, will dry bulk be as good as 2008? I hope so.
Okay. And Peder and JM, what are you doing now to position yourself? Are you buying ships or chartering in or keeping ships short, or what are you actually doing in anticipation of this good fundamental environment?
Well, JM and I, we are sharing a pool together on the Cape-size ships, and obviously trying to stay exposed to this market that we see coming. I think at least in Golden Ocean, we are always trying to balance our portfolio out against the market outlook, and always looking at new deals on both the chartering side and S&P side. And I think also with the fleet of 80 ships in the big or close to 80 ships in the big big ship segments, you need to balance your risk, and you need to sort of manage the downside while positioning for the upside. And I think in the Kamsar and Panamax segments, we are we are taking normally a more balanced approach. That is also where the liquidity in the chartering market is a little bit bigger. While we on the Capesize also see that's where we get the most upsides from this market that we expect to come. So that's our sort of high level take on it as we see the market now, I think.
Yeah, no, that's helpful. I remember, it was a year ago in London, and we were, as an industry, I think we were very bullish going into 2020, and it feels like obviously that we hit the pause button, but if anything, it feels like the demand is kind of loaded, even more than it was a year ago, and the fleet hasn't gotten any bigger, so it does seem good. Andy, you're in a sort of a different boat, so to speak, as a financial investor. What do how do you think about this environment that we're in terms of the kind of global monetary stimulus environment? How is that affecting your business, and how are you kind of thinking about 2021?
I don't know if I have that big of a different view from what Peder and John Michael said. I mean, I think that just if you look at the market, I think what we're seeing is a number of years of underinvestment in the supply side of the commodity sector. And so now as we see that supply squeeze beginning to take effect, I think that's what's supporting a lot of the strength we're seeing in the dry cargo market, for example. Container ships a bit different, as we talked about. And the good news about cycles and commodities is that it takes a while to build up capacity. This is not something you can turn on a dime. So I am relatively optimistic in terms of the dry cargo market, for example, over the next couple of years. Although, the big sort of risk is always more money coming in, as you were alluding to a second ago, Matt. We've had a lot of stimulus. Thankfully, a lot of that money hasn't made its way into shipping. I think shipping is an interesting proposition when it comes to whether it's private equity or other capital providers coming in, and a lot of them have had difficulties over the last 10 years, and probably the timing was not that great. But clearly, as an industry, I think our biggest risk is having too much capital flood the market and all the over ordering starting to happen again. So we want to manage not just the association we have with the underinvestment on the production side, whether that's in metals and mining and agriculture and all those different sectors that I think have suffered historically over the last couple of years at least. But we also want to manage the order book. So, I mean, we're kind of, with shipping, my whole view is you got to be a little bit zen about it. You don't want to get too excited. You want to get too depressed. And, we tend to take coverage as we approach the market. We'll keep some assets open to play the spot market, but we're a little bit more risk averse, and the majority of what we do tends to be down the middle of the fairway. And I think maybe, Peder, you were saying the point, you kind of know when you're in the buying zip code, you sort of know when you're in the selling zip code. And the big risk is that as the market overheats, for the long-term committed ship owners, then that's good because you get good charter rates, and hopefully you've bought cheap so you can get a good return on your assets. But it makes it unappealing from a buying perspective to buy, heavily heated or inflated values. And anyway, I think the good news is that so far so good. People have learned their lesson in shipping, and I think that as long as that continues to be the case, we should see a balanced market for the next couple of years at least.
Yeah, no, it's great to hear that. I mean, I had a call with a German banker the other day who told me that shipping is their best performing portfolio. Last year the tankers were at an all-time high. Right now they are at an all-time low. Container ships a year ago were kind of left for dead as an industry. I mean, 10 bad years, and now they just hit 20-year highs. So I mean, it's I think dry bulk is up next, as far as I can tell. If it's a rotation through the cycles, you guys are psyched. And you mentioned, yeah, it sounds like it. Andy, you mentioned kind of risk and capital formation. Like, in your view, like, what do you think is an appropriate return for these kinds of assets? Not loan to own and not super speculative, but like just money over money, industrial charters to people that really need the ships. Like, what do you think is like a fair risk adjusted, just zip code, as you say? You don't have to give us your secret sauce, but
I mean, I wouldn't say it's necessarily our secret sauce, right? And you know, if you time it right, there's plenty of ship owners that have had great success and gotten in when the market was cheap and done extremely well, alongside other ship owners that have not, because they just timed it wrong. And if you're playing that timing game, then you know you can do extremely well. But I do think there's a bit of a mean reversion when you think historically in shipping. And I suppose if you were to calculate historical returns on an unlevered basis, going back over decades and decades, you're probably going to be somewhere in the, and I've said this before in other marine money conferences, you know, high single digits, maybe mid single digits. I don't know, these days with all the capital out there, and you put leverage on that, and then, you know, your timing can add alpha to that. So, but I think that, you know, a well-timed shipping investment, and we've had our lucky moments, can be PE-like in return, but those are probably more the exception than the rule. I think you have to really compare it also to what's also available out there, right? We got negative rates in European banks. People are getting paid to borrow money to buy houses. You know, there's so much money sloshing around. I think we'll have interest rates low for a while. So at some point, the weight of all that, sadly, I think will just depress returns everywhere. But maybe some of the unique aspects of shipping and the difficulty of getting into the market and doing it right, you know, like John Michael and Peder, like they understand the operating side, they make that happen. I think a lot of people get hooked by the lack of understanding and buying the wrong asset and not operating it efficiently, or just not having the connections to deploy it, you know, efficiently as well. There's thankfully shipping's got a lot of spikes on it that you can get hung up on, and I think others have unfortunately gotten hung up on it in the past.
Yeah, I mean, it is interesting. The equity markets have been super active, although not a lot of shipping equity. And you know, right now there's a tremendous amount of capital in the direct lending market. You know, but it's all relatively expensive capital. So it you know, there's a kind of a push-pull as to whether it will make its way into the industry itself, you know, which is a little bit of a different dynamic. I want to talk about raising equity since you bring that up, Andy. Have any of you guys raised money since COVID? Have you raised any equity since COVID?
No.
We have, but for call it basis risk fund, not for a straight shipping investment, not for a straight tonnage investment.
Yeah. Okay. Andy, on your side, you have LPs that you know you are involved with the real asset world, right? So aviation has not had a great year, I don't think. Commercial real estate has been suffering. Have you seen any more demand for kind of the shipping investments because the other real assets have maybe been under stress?
I think to the extent that you compare it relatively as you just set it out, yeah, obviously aviation's got all sorts of hurt going on right now. It's very binary. Either you're getting paid or you're not, or you're in some sort of restructuring with your rental payments on aircraft. And I think any big lessor in that market's been affected. Real estate's a bit of a mixed kind of texture or tapestry, if you will. You know, if you're in retail malls, for example, you're going to be hurting. If you're in, you know, let's say residential, suburban construction, you're doing extremely well because everybody's leaving the cities for the suburbs. At least they have been in the last 6 or 9 months. But I think with shipping, it's again, it's all how you play it. I think there's always a hesitancy. There's different types of investors that like different types of risk, and you know, an argument can be made that you know, when assets are cheap, then there's a basis play and people can come in and be comfortable with that. But you know, we as far as we're concerned, as I mentioned, we tend to be a little bit more down the middle of the fairway, try to take coverage. We're not going to enjoy, you know, the huge upside. If Cape rates do go to $100,000 a day, I'll be asking John Michael for a glass of champagne because I won't be able to afford one. But you know, but I can provide the beer.
Well, maybe something else together, Andy. We can get that on.
we may have one ship, you know, or 2 ships that we just kind of throw out there. We're very, you know, we're like the grandma on the porch, you know.
JM, I want to shift over to you. I remember it was 2018. You guys were very, very close to completing an IPO. You decided to withdraw. I think it was kind of a funky market condition environment. Any non-sellers remorse or any plans to go back into that market now that NAVs and valuations are up?
No, well, there's a price for everything, but at the moment, even if NAVs are if stocks are trading at NAV, I don't think there's a lot of liquidity or interest in public shipping business, in shipping business right now from the public markets. But never say never. We're pretty happy where we are now. We're paying out some pretty substantial dividends, so and price for everything. But I actually will say this. It's no secret, everyone's been seeing it, that you have this wave of retail money pushing up basically technology stocks right now, a little bit of healthcare. But anyway, you have a wave of retail money in the financial markets pushing up pricing, causing inflation in certain areas. I actually think that wave of money is going to start moving into the commodities market. I think someone like a Bridgewater will put down a big marker in gold or something like that, and then you'll start to see retail follow it. And how it affects us? Well, it affects us because the commodities markets are much smaller than the financial markets. So you're going to have, I mean, big bursts, big bubbles, basically. And commodities are going to be priced a lot higher, and usually that's pretty good for shipping in general, for dry bulk shipping in general. Plus, after that, I think you have general asset inflation, but I do think that you have a wave of retail investors who will overinflate the commodities market, and that will be good for us, because typically when the commodities we carry spike, there's more activity, there's more demand. Things are happening. So
I got an idea for you, JM.
And after that, maybe they'll get to the shipping sector. But let's see.
I have an idea for you, JM. You can rename your company GameStop Shipping and get a Reddit account and do your own marketing. Peder, I want to turn to you. You're our only public or fully kind of liquid U.S. listed company. Have you experienced any of that? Any kind of retail mania? I saw an expression the other day that said "flows before pros," which I think is supposed to demonstrate the power of the retail investor. Is Golden Ocean seeing any change in shareholder base?
I think obviously since the sort of heydays of the last round where with the U.S. money flooded the shipping sector, I think we have been left with a lot of retail demand on the investor side. We are now seeing that a lot of the money or the trading in our shares in Oslo, having a dual listing that we have. So the U.S. interest is limited to that extent. But I don't think that we've seen the institutional investors leaving the sector. But I think they are more cautious now than they were before. And we're with the market outlook that we see now, I think that for sure value investors see that there's a valuation support, a fundamental structural, positive outlook for the market, which is going to bring a lot of interest from the more institutional long-term investors. That's my view. But they are still very shaky and nervous. And obviously you have the COVID situation, and you have also political risk and geopolitical situations that impact the shipping sector, which as you saw, we've seen over the last week, we are all shipping stocks are massively down. So it is that space we see, and that's probably a sign of the retail investors, being the marginal trader of the share and suddenly selling off.
Yeah. Well, it's interesting, and Golden Ocean, obviously you have an advantage, right? Because you don't have a large overhang of, there was no kind of private equity ownership of that business, right? I mean,
no. So I mean, we have the benefit of we have our supporters through our sponsor and have sort of a very long history of treating our co-shareholders or our shareholders well. And I think that supports us also through the downturn. But and I think that's going to benefit us also now where we see the markets stabilizing and where we sort of hopefully can leave this COVID situation and de-risk at least the business case from that perspective.
Yeah, no, the business case sounds absolutely great. Do you feel like you have enough coverage? I know some analysts have left the sector. Some have entered as well, but do you feel like you're adequately kind of marketed with non-deal roadshows and research?
I think predominantly the U.S. analysts left the market. I think the Nordics and the Europeans, they are still there, and I think they follow basically where the demand for shipping stock is. And you know, I do think it's you know, I would hope that would be more interest from the U.S. and I'm sure it will return. But right now, with the sort of limited interest in shipping in the U.S., I think the European, you know, the banks, they cover the investment community in the U.S. also sufficiently.
Yeah. No, it's good. I mean, look, I think it's been a real positive in a way that there hasn't been a lot of equity issuance. You know, the companies haven't diluted. I mean, you guys are just kind of waiting for the market to go where you know it will go eventually. I want to change topics and talk a little bit about decarbonization, which, you know, that's something that's been discussed a lot today. I'm not going to focus really on like propulsion and fuel and that kind of thing, but more like finance and economics and that sort of aspect of it. I guess I'll start with you, Andy. I mean, what is your take on this? I mean, decarbonization is clearly something that's happening. I mean, the momentum builds literally every day. I'm sure you all saw the headline about Jeff Bezos banking a technology to decarbonize transportation. How do you, Andy, as like an investor and an owner of like 20-year assets, like what are you thinking about how to handle this?
There's many different facets to that question, and so on the one hand, you might think to yourself, well, what sectors will be longer term in nature than others? And so you can make the argument that take electric vehicles, they may come a lot more quickly than perhaps we're expecting. Every day we wake up, we look at the news, and whether it's Volkswagen or General Motors, I saw a Hummer now that got 1,000 horsepower and goes 0 to whatever it is, 70 in 3 seconds. And so there's a lot more mainstreaming, I think, of something that was considered peripheral, and there was an argument made that the adoption pace may rapidly accelerate. So you need to think about where you're putting your dollars and assets, I think. So the tanker market is one that one should think about. I do think that from an investor perspective, it's a critical consideration now, and whether it's we've talked about this before, the Morgan Stanley Composite Index ESG coefficient that they're ascribing to publicly traded stocks. Look at the private fund world. There's this new regulation coming out in Europe for Luxembourg traded funds called Sustainability Finance Directive, I think something to that effect, which essentially is going to require all fund managers to classify their funds as either fully ESG focused, so promoting the development of renewable technology that's focused on decarbonizing the global industry, light green, where you're trying to do the best in class, or not, which is the third category. And I would argue that over time, that third category is just not going to get capital. So it seems to me like that snowball is picking up a lot of momentum heading down the hill. But I also would say that, look, this is a capital intensive industry. We're not going to wake up one day and all of a sudden have half the fleet be electric and getting wind power moving it around. There are technical challenges, there's capital challenges. And as we were talking earlier, I think one of the challenges that I think happened in the previous decade with private equity coming in, I think they came into companies that were too small and were a little bit too asset play oriented in nature. My belief and my hope is that the requirements of investing capital in more progressive ESG or environmentally friendly decarbonizing technologies are going to just require bigger companies that have the ability to attract low borrowing costs. I mean, nobody on this panel is paying 8% for their money. They're paying LIBOR plus 1 to 2%, or maybe a little bit over 2. So it's companies that I would argue like ours that are going to have the money to invest and do that leading edge. And so hopefully over time, the mix of that fleet is going to change progressively to have, and LNG we've all talked about and know the story there. It's more of a transitional fuel, but as we get to hydrogen, ammonia, synthetic fuels, that's coming. And it's going to be up to the bigger companies that have the capital and the support from charterers to make those investments. So it's very much front and center how we think about things. And so every marginal ship we invest in, we're trying to do the best we can to pursue that goal.
Okay. Maybe I'll ask you, JM. I mean, what is your? You carry coal, so that's obviously a cargo that is in the spotlight. I know when the Oil Pollution Act was passed in 1990, requiring double hull tankers, there's a 15-year phase out. There's a very natural thing, right? Some people bought new ships, and other people gradually move their ships out of the market over time? How do you think about it, JM?
So, I mean, let's start here with what our CO2 emissions have been. We actually, since 2008, the shipping as an industry, its CO2 is down minus 0.2%, right? And you have a fleet that's 124, more than double, 124% bigger, right? Which means every ton we transport, approximately, we've had about a 55% reduction in carbon emissions. Now, why has that happened? The reason why it's happened is because the fleet slowed down. You also have dry bulks down 20%, containers 25, tankers 20% as well. I mean, you also have a little bit more environmentally friendly regulations in ECA zones, etc. But it's really the slow steaming. So I've said this 1,000 times, and I'll keep saying it because I actually believe the environment is everything, and we can do something about it right now, and we don't want to. So you can slow down the fleet, put a speed limit on it, do it overnight, right? And the carbon emission reduction will be huge. And I actually think we should do that and then reset our 2050 targets, because frankly, I think with slow steaming, you can almost get there. And then I'll say this to all the naysayers who pretend to care or think they care about the environment. Every day that you deny slow steaming because you say it deters innovation, whatever, you are doing damage to your environment, and you continue to every single day. So whatever wonderful solution, sorry, I'm emotional about it, but whatever wonderful solution you have in mind, right, which I don't know what it's going to be, you are adding to its cost every day by not adopting slow steaming. We could actually slow down the fleet, reduce carbon emissions, save a little bit on fuel costs, and actually have a much more efficient marketplace. Today in dry bulk, I can tell you, ships are speeding up to go wait for 15-day trips, to go wait in queues for 35 days. So there's something wrong, and I'm a big advocate of slow steaming, frankly, because it works, and I think it's very innovative, because innovation is the exploitation of an idea. So let's exploit this idea, grab the low-hanging fruit, and have a better market, and most importantly, above all, a better environment. Every day we don't do that, we're just adding to the cost. Just keep adding to the cost.
Yeah, I've definitely talked to a lot of owners who describe their ships, speeding to port to wait, like you described. Yeah. So, on your side, how are you guys thinking about this? Are you doing retrofits of vessels or monitoring, or how is Golden Ocean handling it?
No, I mean, I think I agree with the JM, and I mean, I think this is obviously the fleet needs to slow down, and I think the first thing is now what we see is that it's being pushed throughout the value chain. So through the sea cargo and the Poseidon, every sort of stakeholder in the industry is contributing, and it's starting to see that this needs to be done, and I think that's positive. On the technology side, I mean, that's obviously the reason that we or partly the reason that the order book is where it is that we really don't know what is the right technology, where we should go. I mean, is it LNG? Is it LPG? Is it what type of solution should we go for? And we are part of the Fredriksen group. We have obviously collaboration on what type of technology we are using and should use, and looking at the fleet. We are lucky that we have one of the youngest fleets in the shipping market, which means that they are efficient, or in the dry bulk sector. But this is very much high on the agenda for us, and we are obviously looking into how we can do this, moving closer to the deadline day by day.
I mean, the owners are in such a tricky spot. I mean, it's very complicated. Fast-moving, not always clear regulations, and then long-lived assets. Andy, some people describe a situation where charters will offer long-term employment to owners, and sort of owners like you, in exchange for investing in kind of new technologies. Are you seeing kind of more opportunities like that, like longer term deals?
Yeah, we're seeing a little bit of that. I mean, I don't think it's like it was back in the 60s where you got 25-year charters, but the duration for some of the more cutting edge technology, I do think you can get that. But you're also taking risk, right? So you have to be extremely careful. And as is mentioned, I mean, look what happened in LNG over the last 10 years, right? If you bought an LNG carrier back in 2010, you were kind of going from steam into dual fuel, and you know, who wants to own a dual fuel LNG carrier today, right? It's probably depreciation curve is steepened dramatically. So I know LNG maybe is starting to tap out in terms of containment, and maybe the incremental changes won't be that dramatic, but all of a sudden, I mean, look, I think the other issue is just to talk about new technology. I think to Peder's point, yes, we're all deciding which ships we want to invest in, but I think any new technology is going to need a pretty big infrastructure development globally from a fueling perspective. So you just can't go and start building hydrogen ships unless you have hydrogen fueling stations all over the world. And that's a whole different order of magnitude. And you need partnerships with oil companies and energy majors to do that. So I think, you know, for better or for worse, you know, John Michael, I can get passionate about this too. And the one thing that we all sort of forget is that, yeah, and my sort of comparative point that I often made, if we all went vegetarian tomorrow, one of the biggest polluters globally is the farming and ranching industry. Now, there's probably a lot of meat eaters in the audience, but you know, that I think represents something like 18 to 19% of all carbon emissions globally, right? Shipping is only 2%, right? You know, land-based transportation, huge, right? So I think the electric car thing will help. And you know, we have done a great job, as John Michael mentioned. So I think we're often lumped in because our ships are so big and each individual unit maybe is kind of a big sort of representation, but we need, I think we don't do a good enough job as an industry to herald all the things we're doing. And we're probably one of the smallest industries that's going to make significant changes going forward. And I think we're going to get our hope with the speed limit in terms of what's happening in 23 with double EXI and the carbon intensity index compliance requirements. So ships will have to slow down because they won't be able to comply with those regulations. So I think we need to, you know, we really need to herald how we've done as an industry, because I think we've done a pretty good job and we don't get credit for it.
So I see Kevin's appeared. Just a couple quick questions. Alex gave a great presentation on carbon credits. Are any of you, raise your hand if you've purchased carbon credits or would?
Would. We'd look at it.
Would.
Yet? Okay. And you believe that, you know, there's been discussion about a carbon tax. Thumbs up if you are in favor of a carbon tax.
You posed that question in a very difficult way.
Sorry, that's fine. And last question, or maybe we'll take some questions from the audience. But I mean, do you feel like decarbonization or sort of capital providers' interest in ESG generally, has that affected your access to capital? Maybe Peder, we could start with you.
I think that decarbonization in itself hasn't really affected the access to capital. I think both on the equity markets, I think there will be sufficient equity for good projects. I think it will probably limit the equity availability for bad projects. And I think the equity that will go into shipping won't go into shipping because of its green profile. I think that will be a relative within the sector, but I think so I don't really think that it has impacted the equity side. On the debt side, I think it has been a sort of two-tier or maybe three-tier market where you are either, you know, have funding available from the big shipping banks, or you need to go into other alternative structures. And at least from our side, we are very lucky to have very good support from the biggest shipping banks, and haven't really seen any impact of ESG there either, other than obviously what we are doing with our ESG reports and reporting, happily so, to our banks and to everyone who asks. So I think that's the main impact so far from us.
Andy, how about for you?
Let's keep it simple. I think you got regional differences. I think in Europe, institutional investors are very focused on ESG, and my view is it's sort of the recolonization of the world. It's going to start. It has started in Europe. It's moving to the U.S. Less so in Asia, but it's definitely heading that way. And in effect, you see what's happening in China in terms of their own commitment to renewables. You could also see that becoming a pretty big issue in terms of how they allocate capital domestically in China. So I think ESG is here to stay. I don't see it going away, and shipping will have its challenges in terms of navigating that. You know, there might be certain sectors of shipping that will just be out of favor, and you know, it's hard to predict exactly what will happen. But you know, coal, for example. So, but yes, ESG will have an impact and has had an impact on us raising capital.
Yeah. How about you, JM?
No, I mean, likewise, it's there. It's it's something we should learn to live with and embrace. So yeah, I mean, we mostly use traditional lending banks. We have kind of a generational relationship there. So I mean, a bit like Peder, not that we're as great as they are, but we borrow from normal banks. And I mean, the two things I would say that get you debt financing today are the strength of your balance sheet and your track record. If I was a lender, I would be looking more at a track record than strength of your balance sheet, for the simple reason that someone with a strong balance sheet can also be dishonorable, right? But if you have a good track record over the years, you probably are honorable.
Yeah, that's great. Well, Kevin?
Yeah, a couple of questions, please, but we're kind of running over time, so just prompt answers if you can. Peder and JM, as sort of large ship owners and ship managers, you're also responsible for a very large number of seafarers. And the question is, as ship owners, how intimately are you involved in the welfare and well-being of the crew on board your vessels? And are you hopeful that 2021 will be a better year in respect of the seafaring situation? Peder first, perhaps.
Yeah, I think, I mean, we are obviously first and foremost concerned about the welfare of our seafarers. And I think that's been a very large challenge for us this year. We've had the COVID situation, which has limited the opportunity to change crews, and that has been really stressful on our crew. And we've had also now in China, the Australian coal situation, which has kept ships there without the opportunity to change crew for a long time. And as Golden Ocean, we recently signed up for the Neptune Declaration, which is the declaration that promotes safety and for our seafarers. And I think that's a very good step in order to get that brought forward throughout the value chain.
Thank you, JM.
Yeah, no, so the seafarers they always have a tough time. I've actually sailed over 200 days, which is not a lot, but I can tell you, when you're on board a ship, I mean, we all sit here and we complain about how terrible and difficult our lives are. And yeah, they probably are, but we get to go home every night. Those guys don't. Every single night, you're not getting to go home. You're not getting to, I don't know, be with your loved one or whatever it is you may do. You're stuck on board with those 20 guys or 25 guys. So I think you have to have a lot of empathy for that. And I think the seafarers should be considered essential workers and be vaccinated. And I think that they're the guys that really keep our business going. And I mean, I think we have to be more aware of the trials and tribulations that they go through, because it is tough out there and it is very lonely at times, right? And they are really, as far as the shipping business goes, they are doing God's work for us, so to speak. So yeah, I mean, we work with our crews as much as we can and try and help them in different ways. But yeah, I think as an industry, I don't think we can be too compassionate to our crews ever, right? We can always show more compassion.
Okay, great, thank you. And one final question. It's a bit of a tongue-in-cheek question, but as all three of you are quite optimistic about the market going forward in the next 1 or 2 years. All four of you, Matt, you are as well. So the question is, would you invest your private money in shipping stocks today? And if yes, which segments? So Andy, perhaps to you first.
Well, first of all, I do have my personal money in shipping. I think that, look, I always get worried of shipping, right? When it's up you worry it's going to go down. And we've had a nice run here at the beginning of the year. And like, I think you just got to be observing the order book is what I would say. So always keep your eye on the supply side and think about the longer term trends, right? So if it's priced right, maybe the product market makes sense, but I think, you don't want to get in too late either. So I think timing is important, is what I would say.
Okay, Jem.
I'm a ship owner, and what I consider, I have a lot of money at stake every night, and I have since I was 20. So yeah, I'm fully invested. If you had to ask me what kind of ship to buy, I would of course say a Capesize, or and then a Panamax, and then probably a Supermax. But I think dry bulk, the picture we've all painted, it makes sense, and it's very compelling. So yeah, gun to the head, I'm a dry bulk guy, but I would still buy into a dry bulk sector, and I think that's probably the most beta is definitely with the Capes, and I think that it will actually come to fruition.
Okay, Peder, do you think the kind of physical market is going to play into the kind of stock market in shipping stocks?
Yeah, I think some of these stocks have rallied a little bit and then they fall back. I mean, I think apart from the obvious choice and maybe boring choice here in this panel, the dry bulk market is looking very promising. But I also think the LPG sector is looking strong. Also with the limited order book and an abundance of Asian demand, and also stocks have been trading up, but now they have been falling back quite significantly, so they could be a good opportunity there. And then it's a matter of the tanker market, which may be the market which has it's been hit hardest recently. It's a matter of when this market will rebound, and you can get in at a good level, but it's a matter of how long you have to wait until you get the return.
Okay, and Matt, what about you? Are you a player? Which stocks are going to make your retirement easier?
Yeah. Well, I mean, like most shipping guys, I don't ever want to retire because it's too much fun. No, but as I said at the beginning, we went into 2020 feeling good, I think, for all the right reasons about this business, about the management teams, about the capitalization, about the order book. I mean, it looked great. And, we hit the pause button, but, to me, it seems even better than it did a year ago. I mean, really. So I would say totally bullish.
Perfect. Okay, unfortunately, we're out of time. Thank you very much, Matt, Peder, Andy, and JM. Great to speak to you today. Certainly hope we'll be in person next year in the Dorchester.
Thank you very much.
Thanks a lot.
Thank you. And with that comes to an end our 12th annual Marine Money London virtual forum. To everyone listening in, thank you very much for joining. All of the sessions today will be are recorded and will be uploaded to our website within the next day or two, and you can hear them again. And with that, thank you very much, and see you soon. Bye.
Thanks, guys.
Thank you.